He was the head of ESG at a large bank, and when he told investors to worry less about climate risk, he got attention. And he is no longer in that job. But what exactly did he mean, and how does ESG affect results? We are delighted to have with us a man who challenged the status quo on ESG. He's a columnist with the Financial Times and advisor to many CEOs. So please welcome Stuart Kirk.
Good afternoon, everyone. Thank you very much for having me. This is my first ever time in Oslo, but for many years I thought I'd been here. 35 years ago, I chased a girl all the way from Singapore to Lillesand. And one night we went out in the big smoke, and I thought, that's a really lovely town. Small, but really lovely. 5 years later, I realized it was actually Kristiansand. It's not Oslo that we went out, but it's quite a bit bigger. So thank you very much for having me. This is the title of my speech, which is one of the first titles ever put together by AI. Quite a mouthful, quite boring looking, but I thought we'd set it as a challenge. So indeed, I'm going to talk about common sense, ESG, and finding alpha. Now, speaking of common sense, I thought I had some. So over a long 25-year career, I thought I was a pretty sensible guy. You know, I ran international equities, I advised big banks as a management consultant, I ran the famous Lex column at the FT, I ran research at Deutsche, I ran thematic and multi-asset research, I set up the institute at DWS, and I ran sustainable investment / responsible investing at another large bank. So fairly boring, but one day I got up and made a speech and told a joke about Miami being underwater, and all hell broke loose. And for the next week or so, I was the top story all around the world, including the lovely Daily Mail website, quite an achievement. And I had to go rushing off and hiding on the other side of the world for a while. And no longer I'm employed. Thankfully, the FT, bless them, it was an FT conference where I gave my speech, took me back. It was the least they could do. And now I'm a columnist. But no crazy jokes at this, because I believe it's being recorded. So let's go through a couple of common sense things. I'm mostly a research investment guy. It was only towards the end of my career I started working in ESG. So I'll throw in a couple of common sense investment topics, something about ESG, and finish on alpha, if you will bear with me. So the first thing I would like to follow up with James has said, if he thinks he's bored with the number of people who talk about Fed meetings, we in journalism are even more so. And nothing annoys me more as an investor either than this idea that you hear every single day and you hear discussed in all newspapers and by all brokers that interest rates matter to the valuation of companies. Everybody believes it. In fact, even to stand up here and say this is nonsense usually draws gasps. But it is true, and it is true in theory, and it is also true in practice, and yet we all spend so much time of our lives worrying about the effect of interest rates on stock valuations. And the normal thing you'll hear from my colleagues and others is, oh yeah, well, you discount the rate back at a higher discount rate and that lowers the NPV, blah, blah, blah. But it's simply not true. They are committing a sleight of hand. And let me tell you what the sleight of hand is. This is a depiction of a classic DCF that probably many of us in our room have done. We've got our growth rates going out, maybe 10%, dropping down to 5%, eventually, lower. Then you put a terminal growth rate right at the end, and that spews out some cash flows. You discount those back at a WACC, and you come up with a net present value. And part of the WACC is, of course, the interest rate. So people think if the interest rate goes up, your WACC goes up and your valuation goes down. But what they don't remember to do is appreciate that interest rates there are many things that go into the determination of interest rates, but the long-term growth of the economy is one of them, if not the most important of them. How hot and cold the economy in the future is going to be running determines interest rates over the medium and long run. So you can't lower the WACC and not lower the growth rate in your model. Likewise, you can't raise the WACC and not lower the growth rate in your model. You have to do both. And when you raise the WACC and lower the growth rate, they cancel each other out, or vice versa. It makes no difference to the modeling of a company, if you do it correctly, what the prevailing rate of interest is. And we know in practice it makes sense as well. There has been no correlation over the long run between interest rates and share price returns. Now, instead of share price returns in the dark blue line, I've used the dividend yield, which is more or less the inverse. But I do that because I want to challenge the famous Fed model, and many of us in this room who run multi-asset portfolios, for example, are constantly comparing bond yields and equity yields. But there is no correlation if you go back far enough at all. And I completely agree with James here that we are way too myopic. This period, this long period where equity markets went up and bond yields went down, is the period most of us have invested in. So we always think, oh, rates up, equities down. But it's simply not true. In the 50s and 60s, for example, you had a raging bull market in equities while interest rates were going up. And actually, if you look back at the press and at broker commentary at that time, everybody is trying to justify why it is and why that will continue. After that, they both fell. Then you had a period when you had dividend yields going up and bond yields going down, and now it's a bit of a mess again. At no point was there a straight correlation at all. So every time that you read that rising rates are bad for your long-term investments, and I'm sure James would agree with me, just ignore them. Sure, raise the WACC in your model, but if you're going to raise the WACC in your model, raise the growth rate in your model as well, and you'll find out that the valuation hit is de minimis. So that's common sense number one. The second thing I want to challenge is this common sense idea that rising wages must be bad for corporate profits and therefore corporate returns. And this is a particular topic at the moment, given how high nominal wage growth is around the world, albeit moderating in some places, but it's still high. And actually, the fallacy here is that good things that happen for companies is good for returns. And actually, I implore you to turn that on its head. What you really want to happen is for company management to be challenged by difficult environments, by competition, by higher wages. When CEOs and senior management teams finally have to do some work and invest in new machinery, or think about innovation, or think about restructuring their company, it's amazing how much more profitable they become. And indeed, there is a long-term correlation between, this is US data, but I've crunched it in almost every other country in the world. There's a long-term correlation between employment cost and productivity. The higher the wages of workers, the more bosses have to think, how can we do things better? How can we invest in new plant and tech and innovation and way of doing things to improve returns, given that my workers still now cost more? This is really, really important. And one of my hopes is, if you want the bull case for equities, despite some of the rich valuations going on at the moment, one of my bull points is that this higher wage environment we are in at the moment is going to lead to a resurgence, a long-waited-for resurgence in productivity around the world over the coming 5-10 years, in which case we're more like we're in the sort of early to mid-90s at the moment. Why is productivity so important? Let me just remind you. This isn't a formula, this is an identity. It has to add up. So any change in nominal wages has to balance with change of inflation, prices, change in productivity, and the amount a worker takes home. That makes sense. The only way you can get paid more is to get more of the pie, your productivity goes up, or prices goes up. Flip it around, if nominal wages have gone up, which they have, The beautiful thing is if productivity rises as well, you don't get any inflation, so it doesn't destroy your bond market. And your worker percentage, your share of profits for workers also stays constant. And don't forget that that is just the inverse of 1 over your earnings per share, i.e. ROEs don't crash. So the real reason, the only thing you should look up every single morning when you think, what state is the world economy in, is this thing. Because if that starts rising, we can have this Goldilocks period where workers earn more, there's no inflation that crashes the bond market, and ROEs stay elevated. That is what I worked through in the mid-90s, actually, and it's a very, very fun place to invest. Let's talk a little bit about ESG. So, 2 questions. What is the common sense way to think about ESG? And another question that we're all asked, and we're asked by clients and of ourselves, how can I make an impact as an investor? I want to make an impact, and rightly so. The first one first. The problem with the whole ESG debate, of which I am at the fore, in terms of a critic, is that we currently operate in a world where there are 2 definitions. And when you chat about ESG with somebody, you really need to know which one they're talking about. And the problem is, in newspapers and in financial commentary, the 2 definitions exist at the same time, like quantum mechanics. The first definition of ESG used to be the most popular, and this was taking ES&G factors into account when you invest in a stock, as you take any factor into account when you invest in a stock. What is the exposure of a company to environmental, social, and governance risks? And indeed, a lot of this happens already in a lot of funds. It's called integration. But what a lot of people don't realize is almost all the ESG indices are still run on this basis. An MSCI ESG score is not how good a company is. It measures its exposure to these 3 factors only. On the other side of the room, I think, is what I call ESG output, how good a company is. Does it have a good environmental record? Is it good socially at the office? Is it got good governance? In absolute terms, you can call it sustainable, you can call it whatever you like. But this is how I think most people think they're investing when they buy it. I want to buy good companies. I'm going to buy an ESG fund. That's what they think they're doing. Quite often they're getting that. Yet these 2 people talk about ESG with their own definitions and hit extreme loggerheads. And let me explain how those loggerheads manifest themselves. On this axis, on the y-axis, ESG score, x-axis, valuation. If I'm managing ESG money as an input, naturally I want companies with a good ESG score which are cheap. That makes a lot of sense. But I'm never going to buy a company with a very good ESG score if it's too expensive. Likewise, I'm very happy to buy a company with a terrible ESG score if it's cheap enough. And I've sat across the room from trustees and they've said, why have you got that horrendous company in your portfolio? And I said, well, it's cheap enough to warrant being in there. I know it's got a terrible ESG score, but that terrible ESG score is in the price. The person I'm talking to is thinking this way, whereas they would pay any amount of money for a company with a good ESG score. They just want to own a good company. And you can see this conflict happen all the time. So I implore you, when you think about ESG, to say, which definition are you talking about? ESG as an input or ESG as an output? And that will clear up a huge amount of problems around labeling, around discussions with brokers, and so on and so forth. And I think this is the way that markets are going to end up heading. If you do this as well, a lot of these criticisms of ESG melt away. People say, oh, ESG doesn't increase risk-adjusted returns. Well, for output portfolios, who cares? For input portfolios, yes, it's debatable, and we can have that debate later on in the Q&A if you wish. ESG doesn't improve real-world outcomes, a lot of people say. Well, ESG as an input, it's irrelevant. It's not trying to improve real-world outcomes, it's in trying to improve returns. Likewise, this is a big one. Oh, ESG scores are really diverse. It's terrible. There's such a variation between Bloomberg's and MSCI's ESG scores. As far as an input score goes, great. We have thousands of analysts looking at all different companies with lots of different price targets. It's just another analyst tool, and you would expect a huge variation in analyst scores. So it's only when you split ESG up into its two component parts can you even begin to think about it properly as an investment methodology. The second question is around how do I make an impact? And a lot of time when asked this question, people say, how do you define having an impact? What is having an impact? Actually, I don't think that's the problem. We will get to defining what an impact is easily enough, and regulators are beginning to hone in on a correct definition. To my mind, the big problem here is, how do you define invest? What is the definition of investing? Now, for me, investing is financing something, actually handing over real money to a company or taking it away again. What it isn't is what most of us in this room spend 99% of our time doing, is trading. Trading is not investing. It's taking a security from over here and giving it over here, taking it from over here and putting it over here. That is not investing. So if you want to ask yourself how I can have an impact, to my mind, the surest way of having an impact is through the primary markets, is denying company genuine capital, withdrawing capital and giving capital. It is not sending equity share certificates round and round and round. And even regulators don't understand this. The asset management community is under legalized obligation to lower its secondary market exposure to high-emitting companies. But everybody in this room, if you're each an asset management house, you all can't sell Exxon. It's impossible. Half of you have to buy it if that half sell it, or if you sell it, that half has to buy it. Equity is permanent capital. It is merely traded. And to the people who go, oh no, but if we all sell, the share price will go down and that will raise the cost of capital of the company. No, it's nonsense. It doesn't. And if it does extremely marginally. There are lots of academic papers on this. And it can't happen anyway. Everybody can't sell. And we know this in the real world as well. For the last 15 years, every single institutional investor has been selling their tobacco shares and was the best performing sector in the world. Volumes and selling does not end up in share price or affect cost of capital. In fact, it's even worse than that. It's immoral. It's immoral because selling your equity merely dumps your responsibility to the next guy that has to buy it for you. So when the Church of England says, I'm selling out of coal stocks, the headline in the FT could have easily have been, Church of England forces other buyers to own coal stocks. That would have also been a completely legitimate headline. Even worse, if you don't own the equity, you can't vote. And if you want to have an impact in the secondary markets, the only way you can do it is via engagement. So if you want to hold equities, and we all do, and you care about changing the world, you need to find out a way of voting your shares. Selling does not make any difference, and it's immoral, and it has no effect. So what should I buy then? True finance can happen through these primary market mechanisms more than almost any. So venture capital, private equity, direct lending, loans. So the big banks are dead right to stop lending to high emitters. That will hurt them. That matters. They are wrong to get their asset management divisions to reduce their holdings, however. So in summary on the having an impact, if you want to have an impact on the world, at the top are the areas you should invest in to have the most impact, and they are primarily in the primary markets, and at the bottom tend to be in the secondary markets. With the caveat in red, vote your shares. Final thing on alpha. I've written a lot about active and passive, and one thing that I find fascinating is that like I said earlier, because interest rates, borrowing costs were low, because labor real labor growth was low, because globalization came in, it was very easy to run a company over the last 25 years. My dog could have done it. High margins, high ROEs, it was very, very simple. It was an incredibly benign environment to run a public company, and the quality of management reflected that. It also meant that the dispersion of returns in the public market shrank and shrank and shrank. Now that borrowing costs are rising in the short run, now that labor's more expensive, now that the world is complicated, now that geopolitical risks are higher, dispersion is beginning to rise. And this is a very, very important thing. Now, dispersion means, of course, there's more chance that the active managers in this room will outperform. There's also a higher chance that they may underperform, but at least they have a chance now, and a better chance of outperforming than at any time since I've been in the markets. So this is the time to give active management a chance. And thank you very much for listening. That's my 20 minutes.
Thank you so much, Stuart. If you'd like to have a seat, we're going to bring in, to have a conversation with you, the head of ESG at Skagen, Sondre Myge.
Thank you once again, Stuart. It's always a pleasure listening in to the comments you made. And of course, the HSBC incident was actually a real inspiration for me, having started in Skagen doing ESG in 2019. I was relieved to finally hear an authentic argument in what at the time was a very one-sided discussion. So thank you once again for providing it. I mean, the first question that comes to mind when listening into your presentation is, was the first iteration of ESG, output ESG, ever really about financial returns, or was there other motives driving that rise?
The input ESG, yeah.
No, sorry, output ESG. So most of the AUM today is in output ESG.
Yeah. I think there was a genuine desire of the final client to think that they're doing a good thing while they invest. And I applaud that. I think that's absolutely right. I think people have seen bad actors and bad companies in action. People have seen the climate emergency that's before us, and they want to get a reasonable return on their money while feeling good about themselves. And that's, any survey that you look at shows that that has been the case and is still the case, which is a long-winded way of saying there was a lot of demand, a lot of AUM, and the asset management industry responded to that very quickly. The trouble is that they labeled what was input ESG funds with output marketing.
So how do you think that dynamic will play out? Because obviously you've pinpointed some of the key financial and investment risks with output ESG, yet the flow into sustainable strategies are still very strong. The growth rate has come down a bit, but you still see considerable volume.
Yeah.
And for me, that's a bit of a conundrum. So how should investors and asset managers reconcile that apparent mismatch?
Yeah, well, I mentioned this last night. So the way it plays out is in the courts and with lawyers. There are already over a dozen law firms have been set up in London and more beyond in Europe and the US, beginning to represent clients who feel that they've been missold. And clients feel that they've been missold because they thought they were buying an output ESG product, and then they see that there's Exxon in their portfolio. The asset manager says, well, of course Exxon's in the portfolio. We bought it because it was cheap. We know it had a low ESG score, but we felt that the low ESG score was in the price, and that's why we owned it. Yet the end punter has just gone, I didn't buy an ESG fund to own oil companies, thank you very much. And so there is a huge scope for mis-selling litigation, which unfortunately is no one's fault except the regulators at the beginning of the industry who didn't define ESG clearly. Now, what happens after that is very, very interesting. I guess you just need more complex and detailed labeling. And I still think there'll be demand for ESG funds, particularly ESG output funds, because ESG input funds will just go away. And actually, they shouldn't really have existed at all. I mean, 30 years ago, investing since the dawn of time has looked at weather and culture within a firm and the governance in it. We've always done ESG as input into investments. It shouldn't really exist even as a thing. So what will be left are output ESG funds. Then the question is, how do you measure them? If it's not about returns, how do you measure how well a portfolio manager is doing his job? And indeed, towards the end of my career, I was beginning to talk to clients that were thinking of dropping performance attribution and measurement entirely.
I want to bring in the political dimension of ESG. I think we've seen the broad rhetorical backlash of output ESG, and with regulations coming into the picture as well, you see the broader politics of ESG investing coming into play. And let's start with what seems to be very arduous regulations for ESG score providers, ESG data providers, and so forth. What impact do you expect those types of regulations to have on those entities themselves, but also on the market, given how systematic they are for asset managers in their marketing communication, for example?
Yes, I think the important ones are around the definition of sustainable. So I'm talking about the Article 8 and Article 9 funds in Europe that many of you will have heard of, which need to either have a certain proportion of the portfolio in sustainable investments, or a certain proportion of a company's revenues, or however you want to define it, deemed sustainable. At the moment, there is no definition of a sustainable investment. So when I said output ESG is how good is a company, how do you measure how good a company is? Everyone's view will be slightly different. You may prefer a company with good governance, you may prefer with a good culture, somebody else may prefer a company with good environmental scorecard. We need to be told by regulators what is a good company. Asset managers can't do it. Clients can't do it. Regulators via governments, via a democratically elected process, need to tell us that company X is better than company Y. If that doesn't occur, then we cannot create output ESG funds, because we will all disagree on what a good company is. Now, someone like Milton Friedman might just say, just leave it to the market. And clients will choose. But at that point, the whole thing becomes Wild West, and you end up in court again. But we do need, in a little bit like accounting code, we do need somebody higher up to settle this debate once and for all. Otherwise, it's people like me in a room deciding whether company X is more sustainable than company Y. It's just silly.
I think one of a key example of what you talk about of regulators not understanding primary and secondary markets is the never-ending comments from the EU about using markets to move capital. And one question that's been bugging me is, how are politicians placing too much faith and maybe responsibility in markets to solve what is inherently a democratic topic to be ironed out and solved? The big social topics and climate change questions of the day.
Yeah, I mean, you could argue that. I mean, there are many people in the world who think that governments are outsourcing a lot of responsibility to private markets, private capital, private companies that really should be tackling these issues themselves, from gender to DE&I and so on and so forth. Ultimately, you'll get different companies of all different hues. Some will be a lot woker than others, and that is fine, and investors can make up their own mind. I don't think politicians are sophisticated enough to think, I'm going to get out of having to do anything on climate by making sure companies do it. I think people want companies to lower their emissions. People want companies to lower their carbon footprint and be better behaved. I really think it does reflect the broader society. But there will also be people who say, I want companies to maximize profits so that they generate taxes, and those taxes can then be used to combat climate change, and there'll be a broad church. At the moment, we're heading down a route where the bureaucracy and the red tape is so prevalent that many good companies, A, will either fold or decide not to list, or they will sell their emitting and bad assets into the private sphere, and the world will be worse off for it.
Do you see any risk for market participants sort of playing along with the ideals of the politicians and being sort of their henchmen in financial markets? 'Cause, you could probably end up in a bit of a conflict of interest, right? Which fiduciary do you pay the most attention to?
Yeah, I've been around long enough to know that the financial industry will go where the money is. And this topic, it was only 5 years ago we were talking about inflection points. Have we reached the inflection point for ESG? And suddenly we went from inflection points to it dominating the landscape. And I've been through 4 or 5 of these things over my career. But actually, I think this is very, very healthy. ESG is important. Companies being better behaved is important. The trouble is the money came in so quickly that everybody rushed into creating a set of frameworks that really didn't stand up. The foundations were weak. We really need the bubble to deflate a little bit, to rebuild, get things on a much more solid foundation so investors know what they're investing in, companies know what they need to do. CEOs that I speak to at the moment, they just don't know what to say, where to turn, whether they need to maximize everything on ES&G. Can't I just be good at one? Why do I have to be good at everything? It's an absolute nightmare for companies at the moment, and it really shouldn't be.
One final question before I yield the remainder to Cyril, because you previously described active management as a sham. Before your last slide, you opened up the possibility that this is maybe the time to shine. Do you think there are any other strategies in secondary markets that are better suited to use ESG as an input for alpha generation?
In secondary markets, the best thing you can do if you want to have an effect on the world is probably credit. So credit is a weird one where it's mostly traded in the secondary market, but obviously being a bond, it has a finite life and they need to issue more bonds. So once every 6 months, 12 months, 3 years, 10 years, you can sit across from the company and you can say, I would like this changed, please, I would like this changed, or you're not getting any more of my money. So if you want to hold secondary securities and have an impact, credit is probably the best place to do it.
Excellent. Thank you very much.
Just like to take one question in from the audience, and that is about your talk at Financial Times. One person asked there, when you made that speech, did you foresee the reactions and provocation it would cause?
The thing about tipping points is you never know why things happen. There was a time when the Mona Lisa wasn't the most famous painting in the world, and for some reason, out of nowhere, it suddenly became the most famous painting in the world. And it ends up being a confluence of a whole bunch of things. The timing was right, the political timing was right in the US. The speech landed in the middle of the culture wars. So suddenly, I'm getting millions of emails from Make America Great Again Midwesterners in the US, invitations for dinner from, thousands of women from Texas. It was quite extraordinary. I mean, there were 3 US senators, standing up, sort of backing my argument. I was on TV in Australia. I was called Mr. Kink, actually. Bizarrely enough, my parents laughed. Why things just suddenly burst into flame tends to be a mystery. I mean, it wasn't any more provocative than many speeches I've given over 25 years, but that one just seemed to blow up in my face.
Thank you so much, Stuart and Sondre.